Ever wondered why some people seem to handle money effortlessly while others struggle despite having similar resources? The psychology of money isn't about math or spreadsheets, it's about emotions, habits, and our unique life experiences. Money isn't just numbers on a page, it's a story we all tell ourselves. Today, we're diving deep into the fascinating world of money psychology, revealing how our beliefs, behaviors, and even our backgrounds shape the financial choices we make. So, without further ado, let's begin. Financial DNA. Our early life experiences are like a financial DNA that subtly shapes our attitudes toward money. We come from different generations and families, with parents earning different incomes, holding different values, and facing different economic conditions. These factors shape our perceptions and decisions around money. Consider the stock market and inflation. People born in the 1970s saw the stock market boom during their youth, which made them more optimistic and willing to invest. But those born in the 1950s saw the market stagnate, leading to a more cautious outlook. People in the 1960s grew up during times of high inflation and were more wary of it, while those born in the 1990s didn't see inflation as much of a threat because they lived through periods of lower inflation. These experiences leave a lasting imprint. So, when people make financial decisions, they are not just acting on logic, they're acting on personal history. Even if their choices seem irrational to others, they often make sense to the person making them, shaped by their own financial DNA. Compound kings. Warren Buffett, the iconic investor, earned over $81.5 billion of his $84.5 billion net worth after his mid-60s. His secret? Not just investing skill, but longevity and the power of compounding. Imagine you invest $1,000 at an 8% return. After 1 year, you have $1,080. The next year, that $1,080 earns interest, and so on. With compounding, your money earns more over time, not just from your original investment, but from the interest it accumulates. Buffett began investing seriously at 10. Had he waited until his 30s, spending more in his early years, his net worth today might be around $11.9 million, 99.9% less than it is now. Buffett's journey shows that wealth often grows not by constant high returns, but through consistent investing over decades. Consider hedge fund manager Jim Simons, who averaged an incredible 66% return since 1988. Yet his net worth is only $21 billion, significantly less than Buffett's. Why? Simons didn't start investing seriously until his 50s, giving him fewer years for compounding magic to work. The takeaway? Time is a key ingredient to financial success. Pessimism and money. We're naturally more pessimistic when it comes to money. Good news tends to unfold slowly, but bad news hits hard and fast. This is why a sudden 40% drop in the stock market grabs more attention than a 140% gain over 6 years. Think about medical progress. Advances save countless lives every year, but these changes happen gradually. They don't make as many headlines as sudden disasters or economic crashes. When we see news of financial turmoil, it's easy to panic. But the long-term trend often bends toward growth. So, while setbacks are normal, the general trend in markets, innovation, and progress is positive. Our natural bias toward pessimism doesn't always reflect financial reality. Luck and risk. In 1968, a high school called Lakeside in Seattle happened to be one of the only schools with a computer, which young Bill Gates used to gain an early edge in technology. Gates and his schoolmate, Paul Allen, would go on to create Microsoft. But they were lucky to have access to a computer at a time when few high schools did. Luck and risk are intertwined in every financial success story. For instance, Kent Evans, Gates' close friend, was just as skilled and motivated, but a mountaineering accident ended his life before he could see his potential unfold. Success, then, is a mix of talent, hard work, and a dose of good fortune. Circumstances that we can't always control. Keeping this perspective can help us approach financial decisions with greater humility. The key to happiness. People often pursue wealth thinking it'll make them happy. But real happiness, as author Morgan Housel puts it, is the freedom to do what you want, when you want. with whom you want, for as long as you want. Having more money doesn't automatically mean you're happy. Studies show that well-being comes more from control over your time than from income or luxury. Pursuing money while losing control over your life is like filling a bucket with holes. It's only when money allows you the freedom to manage your time and live on your terms that it truly brings happiness. Why outliers matter more than you think. Some of the most significant events that shape finances are outliers, known as tail events. Think of 𝐼𝐻𝐵𝐵, an art dealer who owned paintings by Picasso, Klee, and Matisse. Most of the art he collected wasn't highly valuable, but a few select pieces became masterpieces, making him wealthy. In investing, this concept of tail events also plays a big role. Venture capital, for example, relies on one or two successful startups to balance the losses of many failed ones. Companies like Amazon have succeeded because of a few major wins, like Amazon Prime and AWS, which compensated for many less successful projects. Tail events are hard to predict, and most people overlook their power. But once you realize that just a few significant successes can make a big impact, it can change the way you approach risk and opportunity in life and finances. Understanding true wealth versus being rich. There's a difference between being rich and being wealthy. Richness is about having a high income or flashy possessions, while wealth is the financial assets you hold onto and don't spend. True wealth is invisible. It's the money you don't spend. We often assume that people driving fancy cars or living in huge houses are wealthy, but appearances can be deceiving. Many live beyond their means, using debt to fund a glamorous lifestyle. Wealth, on the other hand, requires self-control, a willingness to save and invest, and the patience to let money grow. Real wealth isn't about what you buy, it's about what you keep. Embracing risk as part of the process. Investing is like climbing a mountain. You don't expect an easy ride or a golden escalator to the top. You accept that the climb will have risks and challenges. But with investing, people sometimes hope they can avoid these ups and downs. They try to beat the market by jumping in and out. But in doing so, they often lose more than they gain. Long-term investors know that volatility, the highs and lows, is just the price of admission for growth. Investing success requires the patience to hold on through the dips, understanding that enduring the emotional roller coaster is the price you pay for long-term returns. Without it, financial growth is as unrealistic as trying to climb a mountain without facing any obstacles. The hedonic treadmill. Have you ever felt like no matter what you achieve, it's never quite enough? This is called the hedonic treadmill, a psychological pattern where every achievement leads to a desire for more. Wealthy figures like Bernie Madoff, who resorted to crime despite already having riches, illustrate how the constant chase for more can lead to ruin. Understanding the concept of enough is key to avoiding this trap. True wealth means knowing when to be content, appreciating the freedom and security you already have, rather than endlessly seeking what's next. Without this perspective, even immense wealth won't bring peace or satisfaction. Money is more than numbers. It's deeply tied to our emotions, experiences, and the stories we tell ourselves. Whether it's the power of compounding, the importance of time, or knowing when enough is enough, understanding the psychology of money can be the key to financial happiness and freedom. If you enjoyed this exploration, please like and subscribe to our channel for more insights on the journey to a balanced and fulfilling life. Thanks for watching, and we will see you in our next video.